We are finally doing it, the daily bias. This is one that I've been dreading for a long time, but I'm finally getting around to it, and this is going to be a two-part episode, and today we're going to be finally building the plot as to how to show what a daily bias actually looks like algorithmically. So let's get started. Hello everybody, and welcome back to another episode with Sharp Education. Today we're going to be talking about the daily bias, which is something I hate a lot. And it's not baselessly, but we're going to figure out why specifically it drives me so insane. Part of it is because it's easy to talk about and difficult to test. But today I'm going to be building a code in front of you guys and then providing it for free. So you can see how daily bias holds up on any ticker that you apply it to. Now we're going to be using a pretty specific definition of daily bias, but the goal is that you can tweak this code however you would like to define it as, because again, it's unique to everybody, and every time I get it wrong, it's because I did something wrong. But if I provide the code and let you verify it for free, then that relieves me of all guilt. So what we're going to be doing today is making a new file, and we're going to be calling it daily bias, or just bias, B-Y-M-B. And my goal is to use matplotlib's pyplot to make, in statistics, we use box and whiskers plots a lot for understanding distributions of results really often, but they also look like candlesticks but sideways. So we're going to be using the box and whisker functionality from matplotlib to make a 4-hour candle on a minutely time frame. So that way, because day traders generally are trading on minutely or very short-term intervals, we're going to be using that minutely data to make a 4-hour candle, visualize that 4-hour candle, establish our daily bias, and then test its effectiveness. So, sounds like a lot, but I promise when we get started and rolling, it's not going to be that difficult to understand. Just hard to say out loud. So, we're going to import all of the same packages that we usually do, except today, because we're not using economic data, we don't need to bring in the Federal Reserve economic database. So, let's go to one of our regression files and then just take in all of our standard packages. And we're going to load in our initial data as minutely S&P 500 data using another one of our pretty standard data loading packages. So get data looks like this. Bring that in here. And we'll make our global variables defined as well through this code here. There we go. C. And these will be our global variables. We're going to do the minutely interval right off the rip. So this makes perfect sense, and I can get rid of my terminal because I don't need that quite yet. Look back is going to be just 10,000. So look back equals 10,000. So just a maximum look back. Awesome. And we'll sort out our environment, which is automatically done through Jupyter, which is what we have with an IPYNB file. All right. And then I'll make a tiny main function, define main. Data frame is going to equal get data, and then we're going to input by default, we already have the values that we want, and then we'll just return the data frame. So let's run main, try it out. All right, great. So right now we have minutely S&P 500 data. We have 2,000 minutely rows, but I've gotten rid of the index. So I can't do that because we're making a daily bias. So we're going to keep the date time index so we can see the actual minutes of every single ticker that we have here. So on the 11th day of December at 7:01, the close price was this, the open was this, and the high and low. So we have ticker information for all of any ticker we input here. So we can, if you prefer to trade exchange rates, you can do USD JPY equals X. So this is the United States dollar to the Japanese yen. And then Yahoo Finance gives us minutely data on that completely for free. People say Yahoo Finance is an equality source of information, and you're correct because it's not a ton of data. But if I can get this much minutely data for free, I love them. I think they're just such a great of information that's highly underutilized, mostly because people don't take the time to look into content that is sort of boring like this. I'm not glamorously telling you at the beginning of my episodes that this is how I make millions of dollars, actually telling you the opposite. Like, you test it the way I understand how to test it. It doesn't seem very appealing, but I'm going to let you guys make that assumption for your own at the end of this video. Modify the code however you like if you think I'm wrong. I encourage you to do that. I like being wrong. It means I just adapt. I'll change my mind, but that's fine. So we can do exchange rates. In this episode, I think I just will do exchange rates. So what we want to do is we want to make a candle out of the first hour of these pieces of information. Actually, we won't do exchange rates, but you can. We're going to do tickers because of the daily nature of things that trade on the New York Stock Exchange. So, sorry, my eye is itchy. Something that helps me as a data scientist is just visualizing what we have. It's not just me. This is a very common thing to do. So we're going to plot the prices of this minutely information at the beginning of just every time we load it in. So this function is going to include a plot that looks like this. plt.plot, data frame, close, and I'll add this more beautiful later. But now this is what we're going to work with. And there's our plot. So something's going on here. Got a lot of straight lines. Why is that the case? So this plot reminds me why we dropped the index in the first place. Because when plot use matplotlib, that by default uses its index to establish where the values are being drawn. So we are going to go back here and then take this drop index to make our chart more understandable once again. Great. So that looks like cleaner minutely information. Makes a lot more sense. Now, what we want to do is before we drop this index, let's make a new column just to make sure we memorize what the exact date is. So data frame date equals data frame dot x dot values. So now when we look at the data frame, what we should have is an index that goes from 0 to however many minutes we have. And we also have a date that tells us the exact instance this is occurring. So we have 2025, 12, 11, and then we also have the minute. Awesome. So we're going to be using these minutely pieces of information provided for free by Yahoo Finance to establish a daily bias and hopefully making another plot that draws our 4-hour candle based on each of these days. Sounds like a lot, but we're going to figure it out. Okay, so move on to establishing the daily bias through a function. Let's define daily bias, the data frame. Perfect. And what we need to do, first, we're going to want to copy the data frame. Data frame is going to equal data frame.copy. So we're not modifying directly the data frame. And because we're doing a daily bias, we need to sort the minutely information we have into explicit days. So right now, what we have is just a bunch of minutely information separated by nothing but minutes. What I want to do is make sure that each individual day gets its own individual daily bias candle. So we're going to make another column based on our date column that makes sure we have the specific day defined. So data frame day is going to equal data frame date dot date time. Let's add this to our main function here and do data frame equals daily bias data frame dot date time dot day. Does that work? Yes. And let's take a look at our final data frame. Okay. Days starting from the 11th day of December all the way up until the 18th. So again, 1 week of data separated into 7 distinct days now. Perfect. So what do we need to do from there? Remember, we made a copy of the data frame, so we're not modifying directly what our data frame is doing. For now, we're changing it into a copy. This is important later. But what we want to do is take the first 4 hours of each of the days that we've just defined using the group by function, which is included in pandas. So we're going to be adding to this code for daily bias and calling bias info. So the first however much information you want is going to equal. And I'm also going to include the amount of time, bias len. I'll make that a global variable, bias len bias len. That's going to equal, we want 4 hours times 60 minutes. So 240 minutes. So just a quick 240 minutes of the day. Great. So the bias information is going to be small groups of our daily information. Does that make sense? So we're going to take data frame and then group it by, we're going to group it by our day. And I think we want to set sort to be true. And then we want to take the head. So as you know, the head is just the first however many rows of the data frame you're working with. So the head length of the head of the data frame is going to be bias len. So if we set that to be 240 rows, we're taking the first 240 rows of each of the days that we've defined already in our data frame using this column. Great. So we're well on our way to establishing a daily bias by breaking our data frame into a bunch of different sections, one at a time. So as I am making this video from Madrid, the New York Stock Exchange is still actively going on. Now, when you want to do analytical research, you don't want current data updating getting in the way of your results. So for this reason, I'm going to be making this code eliminate the fractured that we're currently operating in, so we can do purely retrospective tests. The next code I'm about to include is a bit tricky to understand. I want you to understand I'm adding it explicitly to make sure that the current day is not interfering with the conclusions of the rest of our studies because it's not a complete day. So the counts are just a list of how many minutes are in each of the days, or if you group each of the biases into days, what is their size? And then to make sure that we have a complete day, we need to drop or get rid of any days where we don't have a group that is the same size as our minutes, like the complete amount of time we need to establish our candle, or the same size as a complete day as defined by counts. This is tricky, but it's necessary. Now I'm only going to return the bias information where the daily bias is established in a complete trading day. So what this will do is allow us to run this code at any hour of the day, and it'll just drop the active day if you happen to be using it at like 2 p.m. on Monday. So you'll never have to worry about the results of your study changing every minute because they will just be getting rid of the most recent active trading day. So bias info indexed by bias info, then bias info day. Make sure that is in complete days. Great. And then we want to reset the indexing of that. And then we want to return the daily bias data frame. So what we're doing is we're taking the data frame and then we're making a modification of it and making it the daily bias data frame. So it's no longer just the data frame, we're breaking it into two. This is important because we are not modifying directly the data frame, we're modifying a copy of it. So we're not losing this data because it will be important later. And I'll stop explaining too much before it gets out of hand. You'll see what happens later on in the episode. So let's take a look at daily bias data frame. Forgot to add parentheses after size. So this is the original data frame, but now let's take a look at what happens when we get our data frame, daily bias frame. And that looks a bit different. There's only 1,200 rows, which is exactly what we want. We have 240 rows 5 times. Great. So we have 5 complete days of trading. Perfect. So the previous Thursday was incomplete at this time, and the current Thursday is also incomplete at the time of me recording this. So we have 5 complete days of trading to establish an effective study on daily biases on the S&P 500. But we can input any ticker, so what becomes a pretty weak study with just 5 days can become very strong very quickly when you input other tickers. We'll do that later. So let's plot the daily biases. So define plot daily bias. Now, and what we want to use is the daily bias data frame. What we want to see is 5 candles, pretty much, using matplotlib's whisker plot. So here's how we can build this plot. Full disclosure, I used ChatGPT to help generate this plot because, again, I like visualizing things, but the plot that I was able to build of our daily bias data frame is really, really bad. So I want to make it look exactly like candles, and ChatGPT was a very useful tool for helping me make this plot. Right now, we have turned the daily bias data frame into our daily bias candles. You can see that this has been a pretty consistently red week for the S&P 500. The day before this was also red, and the daily bias candles also were red as well. So we can read some information here. A lot of people use the candle itself to be part of the behavioral reasoning that they provide. So in this case, the tick that went above the open was the same as the open. Or in this case, there's a really wide spread between the close price and the low price, which might suggest something different. So these are the 4-hour candles that establish daily bias. I have it as the first 4 hours. And if I say the last 5 days, I'm going to say first title. Oh, great. So we already have the bias ln divided by 60. So that's how we calculate the number of hours. So this is our final plot, and you can see that right now the daily bias is negative when we set it to be 3 hours, and it turns positive when we do 4 hours. We set bias ln to be 4 times 60. If we did 3, then we would get the first 3 hours, and if that's how you want to establish your daily bias, then the candles look a little bit different. You'll see that the daily bias is actually negative if you use 3 hours as opposed to 4 hours. So when you understand that, then that means you need to claim that 4 hours is objectively better than 3 hours, and it gets really tricky really fast, and that's the benefit of testing this way. So imagine, hypothetically, you were in a debate with somebody that says, no, the 4-hour candle is the only way to establish daily bias. No, it's the 3-hour candle. They're just debating each other, and they actually don't really know. That's just what they prefer to use, but does it work either way? I think this is really interesting that we made a simple change from 4 to 3 hours, and our daily bias went in the opposite direction. Let's test if this is a useful tool in the long term. And the way we're going to be doing that is by taking our daily bias and then going in the direction of that bias for the remainder of each trading day. Again, we're only working with 5 days today, but if we include a bunch of tickers, we can get thousands of data points to assess whether or not this is actually useful. Interesting. So, arbitrary change, important difference in how we trade for the rest of the day. If we keep making those arbitrary changes and we keep following them, again, arbitrarily, the chances of us making money consistently very, very low. This is why technical information, especially technical trading channels that just make something up, backed by nothing, drive me nuts. So let's keep going. So we're going to make another function, and it's going to be test the daily bias. I did a little bit more work off camera, but that is going to be it for today's episode. I will be releasing a bit more information on how to test the effectiveness by merging some of our data frames together of these daily bias candles. But as I'm sure you can already tell by now, if it's anything like the other dozens of technical strategies that we've tested together, this isn't probably going to change our lives. Now, my claim is that in order to gain an effective edge in the market, you need to be looking at fundamental information and giving yourself a much broader time horizon. We've seen this through an analysis of our risk to reward ratios and some breakdowns on how the stock market actually works. I do this through an artificial intelligence model I built in college. It's called Sharp Edge. Sign-ups are open for the first quarter of 2026 or the year if you're interested in staying with updated results for 4 quarters. There are 2 promotion codes that I have available. One of them is here and the other one is here. I hope you follow along and join the community of people who are using this artificial intelligence to accelerate their investment research. Again, nothing provided on that website is financial advice, but it is my best guess at what is going to happen in the future using quantitative methods that I think I am a proven expert in, if you take any of the research that we've conducted together to be credibility. And that's it. That's my sales pitch. Thank you so much for sticking around for this first episode with Daily Bias, and I look forward to seeing you in the next one. Until next time, Stay sharp.